G'day and welcome to my video. My name is Kyle and I'm going to discuss an article that examines the competitive edge market makers gain by selling shares they do not own and have not borrowed. I am interested in this topic because I suspect that shares I own in AMC and GME have been sold to me by a party that never had any shares to sell. I'm not an expert in this subject area. My own area of expertise is completely unrelated, so I'm hesitant to expand on my own suspicions. Instead, I am going to limit my discussion to the content of an article that is written by relevant experts. This article examines the practice of shorting with failures to deliver rather than by selling borrowed shares. I think the most interesting claim in this article is that shorting in this manner effectively makes the buyer into the lender of the share, or at least into the lender of the value of the share, the amount they paid for the share. So if the shares I bought were shorted in this manner, then I have made a loan to the same person that is shorting my stock. I am concerned that market makers are capable of using their privileges to force me to loan them the same share, or at least its value, that they sold me. I should note that I don't think predatory shorting entities, those that are doing this, will be successful. I am confident in the companies I have invested in, but even so, I am interested in what the academic literature has to say about how they can do this. The channel Simulate and Trade recently discussed the article Failure is an Option, Impediments to Short Selling and Options Prices. I'm making this video to summarize and discuss some of the points made in that article. Please note that my lack of expertise in this area limits the reliability of my claims. Even though those claims are grounded in the article I'm discussing, I'm stupid enough to make a video about a topic that I'm not an expert in, so I'm stupid enough to get it wrong. I'll stress this again at the end of the video. Right, so all of that being said, here's a little bit about the article. In 2006, this article is submitted to the SEC, where it is hosted alongside many other comments received by the SEC. If you Google the article, this is what will come up. You will see a link to the article and a little bit of information about it, including how many pages it is, who wrote it, and how many people have cited it since. Then, in 2009, it is published in the Review of Financial Studies. And here is a screenshot of what you'll find if you Google the name of the article and go to where it is hosted, where it is published, rather than where it is hosted as a comment on the SEC website. So I want to note that Simulate and Trade's video describes this article as an official SEC document. I'm not sure that this is true. The article is hosted on the SEC website, but as a submitted comment. Right? So the article is published by Oxford University Press in their journal, the Review of Financial Studies. So it has the hallmarks of a reliable article. But I don't think this is an SEC document, which is not a crucial issue in this case because the article has been peer-reviewed and published in a respectable journal. But it is worth noting because not all of the comments hosted on the SEC website have been published in relevant journals like this one has. So if you go to the SEC website and look at all the comments they host, you will find a number of them that will not be of the same quality as this one. So just because it is on the SEC's website does not mean that it is a reliable source. Although in this case, it is also a published article in a relevant journal, so we can regard it as such fairly safely. Okay, so what does the article say? This is the abstract, and I've highlighted a few things for me to read out. The article tells us that regulations allow market makers to short sell without borrowing stock. These market makers can choose not to borrow and instead fail to deliver the stock they sold, fail to deliver stock to the stock's buyer. This gives a cost advantage to the larger market makers who can use failing to get a better price or get more profit from selling particular options. So the article is explaining that market makers can and do strategically fail to deliver stocks to their buyers when doing so is cheaper than borrowing the stock would be. This is a kind of shorting, and that is important. So this is what the article says on that. It explains that short sales are usually accomplished through equity loans. The short seller borrows shares from an equity lender, which they then deliver to the buyer. They borrow shares and then sell them, and then have to give back the borrowed shares later. That's a short sale. But if the short seller delivers nothing to the buyer, they thereby incur a debt of shares to the buyer, and this also gives them short exposure going forward. So note that shorting can be a slippery term because it is used to describe specific practices, but also refers to a general state of affairs. So broadly, shorting can refer to any transaction that results in one party owing another party shares. So you are short a share if you owe that share to someone else because you are short what you owe. You don't have it. So intentionally failing to deliver a share that you have sold someone is a form of shorting, despite no borrowing taking place. If I sell you a share, and when it comes time for me to deliver it, it turns out I just don't have it, not even a borrowed copy of the share, just no share at all. Well, I'm now short the share. So, as the article explains, it is sometimes cheaper for market makers to short in this manner than it is for them to sell borrowed shares. Note that the term naked shorting is also difficult to pin down. Investopedia defines it as illegal, and naked shorting is illegal, but it also isn't quite that simple. So some practices that I would describe as clear examples of naked shorting are not illegal. Given the relevant regulations, their questionable enforcement, and the role of market makers, the practice of naked shorting and the term itself aren't so easily aligned. For example, the practice described here involves intentionally failing to deliver sold shares. So I think it is naked shorting. They are selling something they don't have, and they've not borrowed it. They're just selling an IOU. They are naked, the short. They are in a short position, and they have nothing borrowed, so they're naked. However, so that's what I think. However, but genuine market making activities can involve doing the same thing, and this has special provisions in the relevant regulations to ensure that it's possible. Right? So if the term naked shorting is intended to apply only to irresponsible and illegal activities, then it's not clear whether or not we can apply it to this. If the term naked shorting is intended to mean something more broad, more intuitive, like I want to use the term, then it just refers to someone who owes someone a share and has made no effort to borrow or otherwise acquire what they owe. They just prefer to leave the debt hanging, so to speak. So the article goes on to describe why this form of shorting through failing to deliver, is good for the seller, good for the one doing the shorting, but not the buyer. So this is what they have to say. So unlike traders in general, a market maker can short sell without having located shares to borrow. This arrangement is effectively an equity loan from the buyer to the seller at a zero rebate. This is crucial for my concerns because I am interested in AMC and GME, and furthermore, I suspect that a large number of AMC and GME shares that are going through the market are being shorted with a variety of methods loosely defined as naked shorting, or a variety of methods including loosely defined naked shorting. So notice that this form of shorting is described here in this article as a loan from the buyer to the seller. This is because the seller owes the buyer the shorted share. So in a sense, the buyer has loaned the seller the value of the share. If I buy a share from someone and they just do not deliver it, then I've given them the money, but I don't have what I paid for. And so in the meantime, we might consider that a loan. I have loaned them the money I wanted to use to buy the share, and until they actually get me the share, well, it's not clear I bought something so much as I've offered a loan. So shorting is supposed to involve a loan between the lender of the shorted share and the borrower. Right? But if no share is borrowed, because it's simply cheaper to fail to deliver, then the buyer of the share effectively becomes the lender. In my case, as a buyer of AMC and GME, then my shares would be loans to whoever shorted it. Now, given that I do not approve of this form of shorting, I do not want to offer such a loan, especially to predatory shorting entities that I suspect are wreaking havoc on AMC and GME share prices. By the way, thanks to user Unloud from SuperStonk for the term predatory shorting entities. In my opinion, it's much better than the term that's previously been in use, which was short hedge funds. So the article goes on to explain that shorting in this manner exposes the market maker to the risk of the buyer refusing the short and demanding delivery. Okay, so I find this noteworthy because it presents buyers as having a position of power that I do not believe myself to be in. So I suspect that this is because my broker is, in a relevant sense, but not all senses, the buyer of my shares. So the article explains that there is a risk here. If you want to open a short position by just failing to deliver the share instead of borrowing a share, well, then you run the risk of the person you give this failed to deliver share to, you run the risk of them just saying, well, no, I don't want this failure to deliver. I demand you give me my share now. In which case you would have to follow through. And so that's a risk. It saves money to short in this manner by failing to deliver up until the person you're shorting demands the share be delivered. But I don't have that ability. I can't do that. I am not in a position, so far as I'm aware, to demand that my shares be delivered now. In fact, as far as I'm aware, my broker doesn't even tell me whether or not my shares have failed to deliver. Given some other messy complications related to rehypothecation and such, that, okay, I better not tangent, I'll stick to what the article is talking about. Well, given some other stuff, I'm not even sure if my broker knows whether or not my shares have been successfully delivered. I'm sure they can find out. Well, I shouldn't say I'm sure, but I imagine they can find out, but I don't know whether or not they actually follow through. So what I mean is that it would be my broker and not me who would have to contest such a loan. So when it comes to AMC, GME, perhaps the loan is better understood as being between my broker and the shorter, as well as whatever other intermediaries and clearing houses get involved in that mess. A recent due diligence post on SuperStonk argues that brokers' obligations to deliver the shares bought by their clients contributed to the price spike and buying halts in January. Now, I don't know if that due diligence is correct, but it does appear to find a little support in this article. I'll link to that DD in the description, but I better stop there, or I will tangent away my time and lose the clarity that I'm hoping to get through in this video. Okay, so let me move on. Here is the key claim of this article. Naked shorting saves money. And by naked shorting in this case, I mean a market maker using their privileges to fail to deliver instead of borrowing a share. They say that the cost of failing to deliver is the cost of a zero rebate equity loan, and the alternative to fail is valuable, or this alternative to be allowed to fail is valuable and key to the pricing and trading of options. So failing to deliver saves money. So market makers fail to deliver. Their ability to do so appears, or at least this article is arguing, that this is important to determining the prices that people are paying for their options. They have the power to short in this manner, and because it is genuinely important for some market making purposes, they get to keep this power and use it at their discretion. And using this power allows them to make more money on some of their short positions than they would if they had to borrow the stock. So sometimes they fail to deliver. Simple, right? I mean, it's a problem for their competitors who want to short a stock but can't do it without borrowing. But it's hardly the market-destroying issue that we appear to be living through in AMC and GME. Right. So the article does outline the impact that this has. It says that it is widespread, explaining that half the time the market maker shorts a hard-to-borrow stock, it fails to deliver at least some of the shares, and it never accepts a negative rebate, always choosing to fail instead. So yes, market makers regularly do this. Furthermore, they do not undertake practices that could offset the competitive advantage this form of shorting offers them. So the market makers could pursue practices that would correct for the competitive advantage they're getting in these shorting activities, but they don't. And it's worth stressing that this is the point of the article. It is examining the impact this form of shorting has on competition in the market. Specifically, the article argues that this practice gives a competitive advantage to large market makers who have the power to do this and the resources to implement it at a large scale. That's what the article is talking about. There is one more thing I want to say about the article itself before moving on to a brief discussion of the related literature and drawing us back to the situation we find ourselves in with AMC and GME. So, it pays to be big. The article explains that the highest volume option market makers, such as our data supplier, the data supplier they used for the study, for the article, likely benefit from the Clearing Corporation's practice of assigning buy-ins to the oldest fails. So, the bigger you are, the less it hurts you to short via failure to deliver. This hurts competition, but I don't think that's necessarily surprising, right? The article goes on to discuss how they test this hypothesis using their data set, which was obtained from a large market maker. This strategic form of naked shorting, using the term broadly, remember, allows market makers to get a competitive edge when shorting hard or expensive to borrow stock. However, the article does not establish that this practice is used for the kinds of predatory shorting that I suspect are happening with AMC and GME. It is important to clarify that this article does not argue that these market makers are using their shorting privileges to bankrupt companies. Right? It doesn't say anything either way on the issue, or at least it doesn't say anything that I think could fairly be interpreted that way. But the article itself will be, of course, linked, and it isn't behind a paywall, so you can check that yourself if you would like to. Okay, so I have a brief note on the wider literature, and then a point to make about the limitations of this article, and then I'll finish with a note about another article and a book chapter that I think is important for understanding the threat of naked shorting. The wider context. So the article talks about the related literature, and it says that their paper is not the first to document that shorting frictions associate with breakdowns of put-call parity. It's okay if we don't understand the specifics of the claims here. There are two key points I want to talk about. Firstly, the article is answering questions raised by earlier research. The article explains why some shorters are able to make money in situations where others are having difficulty doing so. They use their special powers, which were granted for market-making purposes, to gain a competitive advantage. So they're supposed to be market-making, and it looks like in a bunch of cases they are using the powers available to do that to gain a competitive edge when shorting, and so outcompete non-market makers or smaller market makers. This is important for us because it reveals that there is an academic literature discussing practices related to what we appear to be seeing with AMC and GME. Sorry for my accidental click there. Secondly, look at the dates of these other articles. The relevance of this article and the related literature is limited by the changes in regulations, especially SHO. The data that this article works with has around 11 million observations after they cut away the data points they couldn't use for various reasons. And those 11 million observations are from 1998 and 1999. Right. So To an extent, the key claims of this article predate the current era of regulations we live in. Now, I don't want to undersell how helpful this article is. It is important for us to know that market makers use their shorting privileges to gain a competitive advantage. And it is also important for us to know that they take these advantages, even when, to a layman like myself, it seems unfair for them to do so. Okay. But what this article can't do is prove that there is widespread naked shorting today. So, in that context, let me talk about a related problem. So, the people involved, to an extent, they regulate themselves. This book chapter that I've got a little screenshot of in front of us here outlines concerns that retail traders are being taken advantage of by institutions that utilize market mechanics in ways that were not anticipated by lawmakers and by regulators. It argues that an increasing amount of control is consolidating into a small number of hands. There is a 2013 article, which I hadn't put a screenshot of here. It is called Punishing Bad Brokers. It examines FINRA regulatory actions, and it finds that the vast majority are resolved with fines suggested by the accused party. Okay, actually, I'll stop there. I think that's another tangent that threatens to compromise the clarity and structure of my video, such as it is. So I'm mentioning these other pieces of work, that book chapter and that article, to point out that the claims being made by apes holding AMC and GME are discussed in the academic literature and have been for years. These researchers are not arguing for the mother of all short squeezes, but there are discussions of claims and issues that are closely related to it. So what we don't find is the MOAS theory, or mother of all short squeezes theory, presented wholesale in the academic literature. But we do find many of the points used to argue in support of MOAS theory in the academic literature, where they are discussed, studied and examined, and argued for with reference to relevant data sets. So that's the motivation that drove me to make this video, that there are points that are being discussed on Reddit, that are being discussed in important due diligence posts, and are also discussed in the academic literature. And I'm hoping that this video goes a little bit of the way towards just bridging that gap, especially seeing as it was mentioned in another video, as I discussed at the start. Okay, so important note then, me finishing up now. I am not an expert on any of the topics I have discussed, and everything you have just heard is merely my opinion and is not advice of any kind. The excerpts that I have used from this article will of course be biased by the fact that I was choosing the excerpts, right? So if you are interested in this topic enough to do some more reading, I suggest that the first place you start is the article itself. So I think this picture of a tinfoil hat illustrates well enough that you can't take my word for this, so to speak. Everything I know or think I know about the US capital markets has been learned since February. I'm just a random guy who's fascinated by the topic and absolutely loving the crazy ride that I'm on. So thank you for watching my video. This is a reshoot of an earlier attempt which was compromised by poor sound quality. So thank you to the commenters who advised me to reshoot. I'm hoping to make more videos exploring other topics that I find interesting. They will be of a similar format where I am summarizing and discussing a piece of the academic literature. I suppose I would probably start with those two that I mentioned towards the end of this video, the book chapter and the article. So with that in mind, please let me know what you think. If I do make more videos, well, I would like to do a better job, and feedback will be crucial to me doing that. And on that note, I'm just going to figure out how to stop this from recording. So thank you very much for watching.